Hey friends, I'm starting a new series here on the Ronnie V Show. I'm going to be starting a public portfolio. I'm starting this public portfolio because I don't want any paywalls and I want this to be between us. And I want to go through this journey together. I want you to ask questions. I'm going to actually be doing a lot more live streams going forward. So I want you to ask questions. I want to show you how I'm going to build out this portfolio with high conviction stocks, not 20 stocks with $10 in each of them and hope I hit a hot one and then talk about it endlessly. I'm going to be in a small portion of stocks, typically less than 10 stocks at a time. And I'm going to be going for high conviction. And no, I'm not going to be cherry picking all the best moats in the world and all the best companies. I'm going to be going after a lot of small caps to mid caps because I want to grow this portfolio as fast as possible. Now, there's no get rich quick, okay? There's get rich slow. But I feel very confident in my ability to pick stocks. If you don't want to pick stocks and put in a lot of time and effort that it takes to track, research, and understand these companies at a high level, then your best bet is to simply invest every single month into the VOO, which tracks the S&P 500, which returns 8 to 10% average per year. But if you want to beat the S&P 500, which isn't an easy task, by the way, okay? Everybody makes it sound like it's so easy, but you may be able to beat it 1 year, but beating it over 5 or 10 years, like I have consistently, it's pretty difficult. And that's a slight flex, yes. So in this video, we're going to be going through what are the holdings in this public portfolio, what are my position sizings, what current cash to invested capital I have, how much I'm going to be investing in, or sorry, how much I'm going to be adding to this portfolio every single month. And again, I want to go along this journey with you all. I'm not putting it behind a paywall. I have other portfolios like the gems portfolio and the collective portfolio and my trading portfolios in my discords. Yes, I have those. But this is going to be specifically for everybody to follow along, and so we can talk about this consistently every couple weeks or every week, just depending on what happens, and talking and staying up to date with the stocks that I'm invested in, most convicted in. Yes, and this channel, we'll sometimes talk about stocks that I might not be invested in. Maybe they're on my watch list, or maybe I'll do a video because people want to see it. But I'm really trying to gear more towards, hey, let's just talk about the stocks that I'm really convicted in and really like for the long term. And let's kind of stay up to date with those and the news around them. So without further ado, let's just jump right into it. I'll give you the full portfolio up front, and then we're going to go to valuesnapshot.io. We're going to look at the fundamentals of each company, why I like it, and then we're also going to look at the charts on a monthly time frame, as my whole trading or my whole investing framework is the opportunity matrix, the 3Ds I call it. It's discovery, data, and direction. I don't invest in any company unless we have basically 11 out of 11 of the questions answered, basically leaning towards more bullish and buy. And it's really just about discovery, finding a stock. Is there an opportunity there? And then data, actually getting our hands dirty, getting into the data, getting into the fundamentals, getting into the valuations, and then direction. A lot of people don't talk about direction. I'm a chartist. I'm a technical guy. I like to look at the charts. I like to see where we're at. I like to see where momentum's taking us. And so we'll get into that too, the direction piece of it. And we're going to be mainly looking at a monthly time frame where every single candle is 1 month. So we really get to see a zoomed out picture of where is this momentum taking us? Are we starting to turn higher with solid momentum, or are we just a falling knife right now? So without further ado, guys, like I said, let's get into this thing. So here we are. We have our portfolio here. It was up a whopping 0.34% today. Now, just to give you a breakdown of this portfolio, I'm running this portfolio on public. And I'm using Blossom. Blossom's a entirely free app that has a really nice UI that you can link to your brokerages that tracks your portfolios. It's completely free. If you want the link to that to download the app, it'll be in my description below. You can download the app. It's completely free. If you follow me at the Ronnie V Show, you can actually see every single one of my trades in and out of my portfolio. So I would definitely give it a download if you want to follow along in the public portfolio just to kind of see how I'm doing every day. You can see the performance every day. You can also see every single time I buy, every single time I sell, how much I'm increasing my position, so on and so forth. So it's a really cool app that lets you, the follower and my friend, follow along throughout this journey. And like I said, it's completely free. So you don't have to pay anything, and you can track your own portfolios this way too, link up your own brokerage, add things manually if you wanted to, whatever. But here we go. I won't hold you hostage. I'll tell you them all right now. But if you do want to understand why I'm so invested in these companies and why I like them, and just give you a quick breakdown, there's going to be more videos, guys. So I'm not going to make this too long. There's going to be more videos talking about these stocks, and there already have been videos going over my due diligence and why I'm invested in these. So number one, the biggest position at 21% is ZETA Global. Number two is OSCR at 19%. Number three is Meta at 15%. Pagayo is at 12%. 12% also is Nebius. 10% is Amazon. AMPX is at 7%, and IREN is at 5%. And I actually just bought today, right before the close. So this should bump up to actually 10% because I do want AMPX to be the lowest on this list because it's a smaller company in the materials sector. I do like it for the medium to long term. But yeah, so those are the names, guys. If you want to click out the video, go ahead. But if you want to get some more value out of this and understand why I like these companies so much, then I would stick around. Okay. Also, to give you a breakdown of this portfolio, I started it with $10,000. I'm about $7,000 invested right now. I plan on adding $300 every single month to this portfolio. And again, you're going to get to see all of this if you download the Blossom app. It's absolutely free. And yeah, that's my game plan. So right now I'm about 70-30, 70% invested, 30% cash. And I think I'm good right now. And I'll just stick back to my monthly buys. I think all these are at a great value right now, to be totally honest. So any of these are a buy in my opinion. And that's why I have been buying. You know, if the markets go lower, I do have that cash, about 30%, to be buying. If not, I'll just continue to DCA, dollar cost average, every single month as we go forward. So let's get into the value snapshot.io website. So this website's all basically about knowing what you own and knowing what your stocks are worth. So there's a value analyzer. You can do DCF EPS rule of 40 peg ratio. We have financials. You can compare stocks, run an AI one pager. Also right here, you have the opportunity metrics, which this is my framework for investing. We'll just pull it up right here and we're going to run ZETA first. Okay. So we just punch in ZETA and we quickly get a little 3-year revenue growth of 30%, free cash flow margin of 12.7%. Great. And then we get some questions. And I love this because it just kind of hits you like, okay, go through and answer the questions, answer them truthfully. So for each one of these stocks, we'll do this, and then I'll kind of run a projection, look at the charts here, and then we'll go from there. So Discovery, is this company misunderstood or mispriced? I do believe it's misunderstood and mispriced. It's misunderstood because people don't understand the flywheel that ZETA has. The flywheel being that they have first-party data, and the more customers that they bring in is going to bring in more first-party data. And the more first-party data that they have, basically it's going to increase the return on investment for each company. Let me break this down a little bit easier. So let's say that you're looking for a new pots and pans set for the kitchen. Let's say that you've been looking for this let's just say you've been looking for this and you signed up at some point with ZETA for your data. So they have your data now. I know this can sound a little scary. They have your data now and they know that you're looking for pots and pans. Well, let's also say that ZETA is working with a different company and they know that, or they're selling pots and pans. So they're selling pots and pans. ZETA has your first party data and they know that you're in the market for pots and pans. Now, ZETA doesn't just go to them and say, hey, Christine right there sitting in front of the camera, they want pots and pans. No, that's not how it works. They simply know how to target and where people like Christina are looking and what devices are using. Does she use TikTok? Does she use Instagram? And then the 100 other Christinas, what device do they use? Now that we know what device that they use, we can go to this pots and pans company that ZETA basically is hired through, and they can sit there and say, hey, if you really want more sales, you need to go to, let's just say, most of them are on TikTok. Most of the Christinas that want new pots and pans, that's because of their search history, so on and so forth. They want new pots and pans. You need to be marketing on TikTok. But not just that, it can also break down gender, it can break down age, it can break down your dogs. If you're a pet person, if you're a dog person, you see how big this can be. So that is why people don't understand it. People don't understand the power and the flywheel, how the more acquisitions that ZETA makes gives them more first party data. The more companies that start working with them give them more first party data. The more first party data that they have, the more companies that hire them, the higher the return on investment that those companies get. Currently, for every $1 spent at ZETA Global by any company, ZETA is returning $6 or 600% value to that company. They're going for 1,000% value. They're going for a 10 to 1. For every dollar spent, they're going to return you $10. That's what they're going for. So, understanding that, you quickly understand the flywheel of ZETA and how, yes, they're a marketing platform, but they're very, very good at what they do. And bringing in Athena as well, obviously, that's going to be a very big tailwind for them going forward, as Athena basically takes all that first party data, stores it in her memory, and then you can sit there and just chat as a customer of ZETA. You can sit there and chat with Athena and just ask her, hey, how can I improve our sales? We want to sell more of this product. We have a high inventory of this. How can we sell more of this product? And then Athena will just tell you, this is the targeted ads you need to run, instead of just blanket statement or just blanketing out like, okay, just run ads on Facebook and everywhere. No, you need to target it down. And by not sending ads everywhere and just targeting down to specific locations of your clientele that the first party data and Athena will tell you about, it makes it way cheaper for companies to run these ads. It makes it way more defined on what you're trying to do, instead of just, we need to sell more cars, send out ads, run Super Bowl ads, blah, 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 right? And Athena can also tell you, hey, if you run these Super Bowl ads, you are getting very, very low conversion rates on it, and you're spending all this money on the Super Bowl ad, and it's not really worth it. So then, car company says, okay, I won't run Super Bowl ads anymore. So you guys get it. Well, I just spent a lot of time on that. Sorry, I nerd out over ZETA. But yes, it's misunderstood and it's mispriced, as we'll get into here in a minute. Is there a clear catalyst or fear creating opportunity? Yes, there is. There's a lawsuit out there that isn't in court yet. I do believe it'll be dismissed, but we'll just have to see what happens there. Even if it does go to court, XYZ, they have insurance. So, I'm not really that worried about it. Stock-based compensation is getting handled. That was another fear. And competition, I don't think that's a really big fear. I think they're crushing it in their market. Does the business model have long-term durability? Yes, it does. Data, revenues and earnings are growing. Yes, they are. 16 straight beat and raise quarters. Our margins stable or expanding. They're actually expanding. They're about to flip the profitability too here in the next few quarters. Is cash flow strong or improving? Yes, it is. Is valuation attractive or compared to peers? Yes, it is. Is the trend up and higher on higher timeframes? This is direction. This is talking about these charts that we'll get into. Yes, it is. Is the stock not overbought? No, it's not overbought. Is it not a falling knife? Nope, it's not a falling knife. And does the matrix indicator show strength or breakout potential? Yes, it does. So this is what we get. We get ZETA is an 11 out of 11 opportunity. We get a buy rating. Here's current price, 3-year growth, free cash flow margins, and all the questions we just answered. And you can also copy this, paste it, share it to social media if you wanted to. And then we get, okay, well, now do we want to look at financial charts? Do we want to look at the value analyzer on this thing? Do we want to compare it to its peers? Do we want to save it to the watch list? Let's go and look at the financial charts. So we're just going to pull up the financial charts, ZETA. And we can just get a brief little description, quick insights of the company. We can put this on let's put it on a quarterly. So you guys can really see where we're going here. So on a quarterly basis, you see that gross margins, operating margins, net margins, and free cash flow margins are all up and to the right. All up and to the right. And then our revenue is up and to the right as well, consistently climbing higher. And our net income losses are getting less and less. Flip to profitability, had a loser, a little bit higher, had another winner or almost winner. And we're just continuing to climb higher. You can also see it on a trailing 12-month with our revenues and net income, just continue to climb. And you see the net income losses are getting smaller and smaller while revenue continues to expand. Margins continue to expand. Gross and operating profit continue to expand. EBITDA is fully flipped. Cash flows are continuing to run higher. CapEx and dividends are continuing to fall. Operating expense, balance sheet overview, cash to debt, 385 million to 196 million debt. Shares outstanding are climbing, but they have been, kind of stabling out compared to what they were doing. And earnings per share are about to flip as well, like we just talked about. So what does that mean? This means that it's a great opportunity. You clearly see it. This is what we want to see. We want to see revenues continue to grow. We want to see operating margins continue to grow. We want to see gross profits and operating profits continue to grow, EBITDA flipping, and just quarter in and quarter out, them continue to deliver like they do. They play the Wall Street game very, very well. They underpromise and then overdeliver. It's a great cycle. And David Steinberg, the CEO that I actually interviewed in December, full videos on my YouTube if you want to check that out. I'll try to link that below as well. But great guy, met him in person as well at ZETA Live. They invited me out to that, and I'm a strong believer in him as the founder of this, co-founder of this company, and the team that's back there behind ZETA. They're just crushing it day in and day out, and I think they're going to continue to crush it. Value analyzer. Let's see if this is a opportunity. Let's see if it's a buy. So my favorite metric to use is the discounted cash flow model. If you go up to the top here, you can see DCF, EPS, Rule of 40, PEG ratio. We're just going to simply look at the discounted cash flow model. Their current revenue is sitting right about 1.4, oh gosh, 1.4 billion. The revenue growth rate over the next 5 years, let's do a 5-year projection. So over the next 5 years, they're expected to grow 35% in 2026 this year. Let's just base it out and say they've been growing over 20% per year. Next year, they're going to grow 35%. Let's just base it out around 27% yearly growth over the next 5 years average. They're currently at 12.7 free cash flow margins. But as you saw on that last screen, their free cash flow margin was actually 14.7% in this last quarter. So let's just run this at 15% free cash flow margins. And then let's give them a terminal fair value of 20. This company's growing at 20% plus. You can honestly give them a 30 if you wanted to. Let's just keep it conservative with a 20. And what do we get? We get a current price today of $21.59. Intrinsic value is $46.19. Almost, over double from here, and a 5-year target of $62.44 on pretty conservative assumptions. 23% CAGR. What did I say the S&P 500 gets you per year average? Remember? 8 to 10%. 8 to 10% average per year the S&P 500 gets you in like a VOO or something. This is giving you 23.7% if you believe these projections. 113% undervalued, 114% undervalued from today. Let's just get really conservative. Let's just say they only grow 20% revenue growth. Let's say they stay at the 12.7%, and let's say they stay at 20. Well, still 38.9% undervalued. So let's say they continue doing what they've been doing. That's very conservative as they're about to grow 35% this year. Let's say they stay at their free cash flow margins, even though they're higher this year, or sorry, this last quarter at 14.7%. Let's give them a measly 20 free cash flow terminal multiple with a 10% discount rate, 39% undervalued, still looking at a $30 stock basically, and 39% higher from here. $40 5-year target, that's still going to get you 13% annually growth. Again, crushing the 8 to 10% of the markets. This is where alpha is. This is how we use discovery, data, and then direction, as I'm about to get into here in a minute, to find great opportunities, great companies, get in them early, and then hold them. ZETA is a real winner over the next 2, 5, 10 years, in my opinion, based on all the due diligence I've done, based on all the due diligence I have done, and the continued research I do, and the belief in the company, and just my knowledge of overall companies and valuations, and looking at the numbers and looking at the total addressable market, how it's going to continue to increase. It's a steal deal today, honestly. It's a steal deal today, and I just see them continuing to climb higher. Now, direction. The direction is very simple. This is a monthly chart. This is my matrix indicator. The matrix indicator it tells us the overall direction. It tells us when we're bullish. It tells us when we're bearish. Very simple. This is bullish, a bull trigger. This is a bear trigger. And it's basically these lines crossing in this histogram, going up and down like a pendulum swinging. Now, you based out from 2021 to 2024, you saw massive price expansion after the breakout, all the way up to $38 from a low of $5. And then you saw us peter out. The bear market came. Sorry, no, the bear market didn't come. They actually did. Oh, here's the bear market right there. Sorry. Here was actually the short report and the lawsuit being announced, and that caused them to absolutely tank. They came all the way back down to this support area, basically the 13 EMA. Or sorry, this is like the 50-day moving average. This is the 13 EMA right here. So they came all the way down there. They held, and what did they basically do? They basically came down and retested this base breakout, and now they've been basing again here, holding, and just in a consistent uptrend, higher, higher, higher. Now they're above the 13 EMA. They just launched off this massive volume shelf, and I see them going to $38.34 over the coming, basically in 2026. As long as there's no bear market or anything crazy in 2026, I think they'll go up to 35 plus, 38, maybe even more, honestly. If they're able to break over all-time highs, I can definitely see it because they're severely undervalued, like we just talked about. So the direction is there. You're about to get a bullish cross. You're creeping higher, stair-stepping, about to flip this zero line. And once we do that, it's all sunshines, rainbows, and roses to the upside. So we have all three. We have the 3Ds of the opportunity matrix. We have the discovery, the data, and the direction. They're all on our side, friend. All on our side. So let's get into our second stock, OSCR Health. And you know what I think I'm going to do, guys? I'll tell you this right now. We're already 24 minutes in this video. How about this? Let's make it a real series. We'll make this part 1 of the public portfolio, unless you want me to do an hour video. I doubt you want to do an hour video. I doubt you'll sit here through an hour video. So let's do part 1, my 2 highest conviction stocks, ZETA and OSCR, and then we will go into second part. I'll make a new video and we'll release that next few days. How about that? Sound good? Awesome. If you like that idea, say you like that idea down in the comments. Like the video. Haven't asked you to do that yet. Like the video. I'm small on YouTube. So like the video, subscribe if you want to see more of this content. If you want to follow along the public portfolio, I really appreciate it. And drop a comment below what you think of the public portfolio so far. what you think of Value Snapshot. And yeah, if you have any questions, drop them in the comments below. I get to all the comments. I answer everybody's comments. So yeah, drop below. OSCR Health. OSCR Health. Love me some OSCR Health. OSCR Health, like I said, they are basically going into a legacy dinosaur company space in health insurance. They're bringing in AI to basically have this simple app that you can talk to and kind of talk about your symptoms, and they point you in the right direction to get care. It's really nice, really seamless, really easy. They're led by Mark Bertolini, which was a previous CEO of Aetna before they got sold out to CVS. And he also was on, he was the co-CEO next to Ray Dalio at Bridgewater. So he knows the health insurance industry. He had massive price appreciation on Aetna as well. And then he knows the stock market industry as well. The man is a beast, just to put it simple. He's a beast. He knows what he's doing. And OSCR Health, it's really funny because they have thrived on ACA subsidies. If you know anything about this, have looked at the news, you understand that ACA subsidies are a big hot topic right now between Dems and reps, and they might not get extended. If they don't get extended, people are expecting this huge, this cliff of people basically not signing up again because it's too expensive or they can't afford it or they just don't want it. And the data that we're seeing coming out so far for this year is that the cliff really isn't a cliff. It's like a step down. They're expecting 15 to 20% losses, and they're actually only getting about 0 to 3% losses. And we're not even done yet either. And that's the majority of the people that actually drop off. So we do have some more data coming out, and towards the end of it, that's the people that typically, come on and don't really drop off. So yeah, we're seeing some really, really good signs here, which just all means that 2026 could be an amazing year, even without ACA subsidies for OSCR. And that's huge because, as we're going to get into, they had one 2025 negative year, but I think they're going to bounce back. The CEO said they're going to bounce back and have a profitable year. And if you look at free cash flow basis, they're still crushing it. They're still severely undervalued. And you're going to see why this is also a steal deal and why this is another one of my high conviction plays. So let's look at trailing 12 month. Okay, so we can see operating margins have come down a little, net margins as well. You see 2025 Q1, 11.8% free cash flow margins, net margins 1.2, 1.4. And then we've gone down on a trailing 12-month basis and also on free cash flow from 11.2 to 6.5. The biggest reason for this was medical loss ratios. Medical loss ratios, basically, they spiked across the industry. And you have to look at it like this. Before the year starts, health insurance companies look at the markets and they say, okay, how do we price this correctly so we're not coming out of pocket halfway through the year? Because if they have to come out of pocket halfway through the year to pay for everybody's health insurance, medical bills, that's not going to be good. And that's where, some financial issues could come up, right? Because like a bank, you're like borrowing money. And if you borrow too much money or the bank doesn't manage its money rate and it doesn't have enough money to borrow, then things get really, really bad, really, really quick. So they basically have to make sure they're pricing so they make a little bit of money and they don't lose out, right? Well, this year they lost because them, and not just them, everybody else in this industry priced for basically X medical loss ratios. Well, they all spiked and we got like up here. So across the industry, not just OSCR problem, it's not OSCR's fault. It's across the industry. Nobody was expecting it. Saw a spike and they had to come out of pocket. And this is where you're seeing this loss. But the thing about this, the mean is like 80% medical loss ratio. It spiked up to almost 90% across the board today. So what do we know about means? Means revert. You always revert back to the mean. So now for this year, 2026, they priced up here on the higher side towards 90 on the medical loss ratio. But if we revert the mean back to 80, then guess what? That's going to be buku bucks for Oscar Health. That means they're going to make a lot more money on the bottom line. But I will say there's laws around in the health insurance industry, and they can only take so much gain. Okay, so it's not like they're going to get all of that. They're going to have to return some of that to the customer and basically say, "Hey, great news. We overcharged you. We didn't need to use all this. Here you go. Here's a check back for you." But it's still really good for Oscars because they're still going to make a ton of money off of it. So where do we see trailing 12-month basis? Well, we were good. And then basically this past 2025, we saw this drop off. We went negative, right? This is on a trailing 12-month basis. If we look at a quarterly, we'll see it a little bit better, right? It's kind of all over the place on net income. If we take out the revenue, it's like, oh man, yeah, that's not good. Here's the thing. They were trucking towards profitable. They hit profitability. They were good. And it's always these last two quarters in the end of the year that are the worst, right? Q3, Q4. So they were good. And then they had profitability. They were going to be good. And then it was way too high. Maybe you can see it easier on the yearly. Here you go. Hit profitability. And then obviously 2025, they went back down to unprofitable due to this one medical loss ratio spiking. But overall revenues are just exploding, by the way. They are exploding. Look at these revenues. So the thing is, let me just break it down real easy. Revenues are continuing to climb higher. They're going to get this net income. They're going to become profitable again. And it's going to be great because the higher revenues go, when they do get the net income figured out, the more money, the more net income they're going to make. Operating profits are continuing to climb higher. EBITDA flipped, like I said, we just talked about that. Cash flow overall is climbing higher besides this one MLR stuff that's happening. And then cash to debt, they have way more cash than debt, which is really good. And where's it at? Where do I want to show you? Quarterly. Yeah, just look at these revenue growth rates climbing. And again, free cash flow, net margins are all over the place again due to the medical loss ratio. I know it's a bit confusing, but if you just believe that they're going to go back to being profitable and they're going to be good to go, and you see the massive amount of revenue they're having, 9 billion this year, about to be 12 billion for 2025. Sorry, 2024, 9 billion, 12 billion for 2025. And then they could hit, who knows, 14 billion in 2026 this year. If there's not a huge drop-off cliff for ACA subsidies, so on and so forth, right? And you see, let's just talk about the overall trend. The overall trend is that the margins are getting under control. The margins are climbing higher. And their own CEOs said they expect 5% net margins in 2027 and about, I think, 14 or 15 billion in revenue, which I think they might actually smoke that. And again, if you look at things and understand that net income compared to the revenue, they get the 5% margins, they're going to be massively undervalued from where they are today. But okay, let's look at the analyzer and then we'll do it reverse order. We'll look at, actually, no, let's go look at it now. So look at the opportunity matrix, run through this. Oscar, sweet. So is the company misunderstood or mispriced? Yes, it is. It's massively mispriced and massively misunderstood. Everybody thinks that they're only going to be able to make it with ACA subsidies, and that's just not the truth. Is there a clear catalyst or fear creating opportunity? Yes, ACA subsidies. Does the business model have long-term durability? Yes, health insurance is very durable. Revenues and earnings are growing. Yes, revenues are growing. Earnings, a bit mixed right now, but they are going to continue to grow. Are margins stable or expanding? Yes, over the long term, besides 2025, due to medical loss ratios. You just understand that. You understand that margins are continuing to expand and grow higher. Oh, SG&A costs, what I wanted to show you. SG&A costs basically are continue to go down. So they're spending less and less money on, you know, things running their business, essentially. Is cash flow strong and improving? Yes, it is. Is valuation attractive compared to peers? Yes, it is. Is a trend up on higher time frames? Yes, it's not overbought. It's not a falling knife, and the matrix does show an indicator breakout potential. So let's look at the value analyzer. We got 11 on 11 there. Analysts have one strong buy, four holds, 3 sells, and 2 strong sells. Going to run a DCF model, saying 11.289 billion for trailing 12-month revenue. Let's just bump that up to 12 billion. I'm sorry. 12 billion is what they're going to have for this year. They're not going to grow 71%. Let's just say they grew let's say they grow 15% per year. Let's say they stay at this current price free cash flow of 7, which is super low. 156% undervalued, guys. $17.42 is the stock. Intrinsic value is $44.73. 20% CAGR. So they only grow 10% per year with 6.5. Again, remember, they were at 10.4% free cash flow margins. So they get back there, all bets are off, guys. And this is what I keep telling people. Just beat it up. Say they grow 5% per year, which is garbage. Like with ICRA and everything, and ACA still being their primary business, that's garbage. Let's say they drop to 5% free cash flow margins. Let's say they have a 5 terminal fair value. You're still undervalued today on the worst assumptions. What are we even talking about? Now, are you 100% undervalued? No, but what do you expect this market to do? What do you expect them to price in? Come on, guys. You're still 14% margin of safety, 14% undervalued. It's crazy. It's crazy. You want to see my actual projections? I think OSCR will have. Honestly, let's give it my bull case. I think they grow 20% for the next 5 years. I think they get free cash flow margins up between 13 and 15%. Let's take the low end of 13%. And I think they have a terminal multiple of 15. Is that crazy? Is that crazy? Yeah, it's crazy. Yeah, it's crazy. It's very crazy. It's very crazy. And this is why I showed you the worst case scenario. The worst case scenario. And we just have, like, we're still undervalued. And then I show you a bull case for me, which is, it's not even crazy, guys. For them to grow 20% per year, they've been growing 89% over the last 5 years, 71% over the last 3 years, 56% over the last 1 year. This isn't a $100 billion market cap, guys. This is around a $5 billion market cap, $4.81 billion market cap, pulling in 11.29, 12 billion in revenue for this year. Price to sales ratio 0.43, free cash flow margin of 13. Guys, like, if ACA subsidies are extended, then this is like way super more likely. Way super more likely. If they're not, like, they could still do this. I'm telling you guys. Like, it would not be crazy for them to grow 20% revenue for the next 5 years. It would not be. They're super small. They're super small, guys. Free cash flow margin of 13%, only a little bit higher than what they were doing last year. 15 terminal fair value based on free cash flow. Guys, I trust me, I get it. 183, that's crazy. But I'm just saying, you beat it up. They're up 10%. Say they do what they're doing right now, and let's just give them a 10. 166% undervalued. People wonder why I'm so bullish about this company because you just beat it up in the numbers, man. As long as you believe in the company and the CEO, Mark Bertolini, it's really hard not to really like this company. Okay, let's get into the direction, the overall direction. Looks very similar to ZETA actually. You had this IPO of about 36.83. You had this fall from grace. 2022, 2023 wasn't good. Consolidation. And then you had the bullish cross, bullish flip on the histogram. You had the breakout. You had the flip of the EMAs. And you rode this thing from the breakout of 10 up to about 23.90. Since then, you were seeing more consolidation, more consolidation. I've been talking about this stock since beginning of 2025. And since beginning of 2025, basically right in here, we've been in a range of 16 down to 11. I was buying all the way here. I was buying all the way up. I was buying all the way down. I was buying all the way up. I was buying all the way down because I knew that this company over $23 fair value or anything under $23 is a steal, in my opinion, based on what I'm seeing on the fundamentals and everything, right? Look at, I got so much stuff to get rid of. Massive volume shelf, been in this consolidation zone. You have this overall huge cup and handle pattern. Basically, once you break over 23.79, you hold up here, you maybe retest it, you're not coming back down to this range. And we have price targets up to 36.92 and 45. And for the matrix right now, you printed a buy, then a sell. And basically the best thing I could say is consolidation, showing the same consolidation on the chart or on the matrix. It is what it is. But yeah, this nice volume shelf we just keep sitting on top of. We're actually continuing to climb higher on the 50 and climb higher on the 13 EMA. So overall, there is an uptrend here. There is an uptrend here. Lows, high, low, or higher low, almost a higher high, higher low. Like I said, overall, there is a trend here. There is a trend here. It's just a crazy trend. It's very volatile, guys. Very volatile. Trust me. I've round tripped from 11 to 20 to 14 to 20 to 13 to 20, like over and over and over again. And people on X, I've been calling this name out, and people on YouTube here, people have just been like, Ronnie, what the? When are we going to see real consistent gains? Because, like, there's, I have some gains. Don't get me wrong. 15 cost basis. I have some gains, but I get it. Like, but good things come to people who are patient. Good things come to people who are patient, guys. They really do. So if you got the stomach, if you got the patience to hold names like ZETA and OSCR that have round tripped and bounced around a lot, and maybe you didn't get the best cost basis, so on and so forth. If you believe in the company, you have high conviction in the companies you buy, whether they're these ones or whether they're other ones. As long as you have high conviction and you understand when they dip, they are an opportunity for the long term. That's really what it's about. Okay. I know this video is long. I know I didn't get to showcase all the stocks. We only did 2 of 8. That's okay. I'd rather be thorough. I'd rather go through my stocks thoroughly so you understand why I'm so convicted in them. So if you appreciate this video, if you're still here after 43 minutes, I appreciate you. I love you. You're awesome, friend. And yeah, I appreciate your support on this journey. And I hope I provide value to you all. And until the next video where I talk about the next 2, hopefully I get a little bit more than 2 in there. Probably because these are my 2 highest convictions. So who was I kidding to sit here and think that I was going to get these done all in one go? But please don't take this as clickbait or something like that, where I'm sitting here like, come in for 8. I gave you all 8. I just didn't get through them all. Sorry. I'm a talker, and this truly wasn't designed to be a series of, let me go through all these different. It was truly designed to just be, let me tell you all of them, but it didn't work out that way. All things don't work out like we planned, huh? But I appreciate it. Hit that like button. Do me a favor. Hit that subscribe button. Hit that notification bell so you don't ever miss a video or part 2 of this public portfolio revealed. And yeah, I'll catch you guys in the next one. Have a blessed day.